What's up YouTube, Carboss here, back in another video where we talk about cars, money, investing, and welcome everyone to a new segment of my channel. Trying a different mode of presentation, which I mentioned before in my thank you video a couple of months back, where I wanted to get in front of the camera to basically talk about car investing in general, not exactly a vertical, be it sports, Marvel, or F1. I haven't thought about a title yet, so if you guys got any suggestions, feel free to leave in the comments below. So to kick off this first episode in this series, I'm going to share a strategy about card investing which you may not have heard before on YouTube or social media. So, alright, so let's go. Okay, first I'm going to talk about what most people are doing and share with you what I'm actually doing differently. So I think by now most of you are quite familiar with the narrative of the standing operating procedure of card investing, be it sports, non-sports, or trading card games, which is follow a bunch of content, right? Do your research on comps, look at charts, data analysis, budget your purchases, and ultimately, place your bets. Then it comes down to listing and flipping and making those kind of profits, right? Sounds very, very simple. Now, if only that was the case, because what we're actually seeing consistently is wild fluctuation in prices, razor-thin profit margins, popularity of players or characters, don't turn out the way that you imagine them to be. And of course, we do hear those positive stories, right? Whereby on YouTube you see those big flips, cash outs. But in general, you ask yourself a question: why do you think that you feel less excited or enthusiastic, when you are actually in the middle of the investing game as opposed to, prior to it? Well, just let me sum it up for you to one simple word: expectation. Right, so I believe that a lot of you guys, myself included, at one point come to this hobby with a strong expectation to make some money. But some of us expectations are kind of higher. Seeing what our peers actually are doing, getting those 2x or 3x returns. But when it comes down to it, why most of us are not actually getting those kind of returns? Well, it's easy to blame the economy, timing, players' performance, etc. Right? But ultimately, these factors are kind of like outside of our control, and we sometimes fail to recognize that our expectations need to pivot constantly when the external forces are actually changes, right? So therefore, in order for you to manage those expectations better and to make you a better investor, your thought process kind of have to be a bit different compared to everyone else. Now, I'm not saying you don't do all those things, all those important things I mentioned earlier, like research, budgeting, those are extremely necessary. But what I'm saying is there is some subtle difference which may ultimately let you kind of get ahead with everyone else, and here's how. The perception that a lot of card investors have, especially new card investors coming into the hobby, is that they can make quick and easy profits no matter what item they purchase. Of course, whatever that they have acquired has clearly come with necessary research and some level of confidence that the item can sell at a profit, taking into account things like fees, shipping, etc. Right? While the fundamentals are the same for all card investors, what is actually subjective is the profit margins itself, where that's a measurement of value for the time you spend that you actually invested in acquiring the card up to the point of sale, right? Most people don't put much thought into that, and they take a standard approach, right? 25%, 50% margin, 2x, whatever, right? Sometimes these kind of like realistic guesses, and maybe they are accurate at sometimes, right? But most of the time, the expectations are totally unrealistic or kind of like not backed by any logic. And here's a simple illustration, right? So you buy a card for $500, and the price comes on 130point.com, say it sells for around $700. You factor in fees and shipping, and at the comp selling price of $700, you kind of clip a profit of about $100, right? So say you list it on eBay for $800 or best offer, all right? And likely taking the first offer at $700, which is the desired price. But what you find most of the times is you get offers for $500, $600, right? And the longer the card actually sits on eBay, for example, you get frustrated, right? And why hasn't your card sold at comps? Now, I'm not saying this happens all the time, but it's a common situation that a lot of us face and makes us doubt ourselves as a card investor. So rather than sitting around and start questioning yourself, right, it becomes important for you to think on how proactive you are at wanting to turn a profit within a particular time frame. Some of us don't have kind of like timeline, so they don't mind letting the cards sit there until the right person comes by, and then that's perfectly okay. So when I say right person, means that the right buyer, who's willing to meet your price expectations or your asking price, and also take into account all the external factors and the considerations I talked about earlier. And but there, of course, there is another way, right, to take a proactive approach, and that is balancing the time versus money. And how do you do this? Is to set a time threshold on all your inventory, marking down your profits in order for you to recoup capital and redeploy. Now, what do I mean about that, right? So in the earlier example I mentioned, you had a card that had a desired target profit of $100, but say you set a 30-day time limit, meaning that if the card did not sell for the first 30 days, it's probably time to reassess the market value of that card to move, and perhaps considering lowering your profit expectations considerably. Right? And what I mean, it's not by dropping like 10% or 15%, it's like reduced by half or 50%, right, or more, right? So this would mean that if your initial profit expectation was $100 based on current comps, that would be reducing to your profit margin of $50 or less. Now, what that does is actually two things, right? So A, you're likely to move your card very quickly, right? The moment you reduce the price and set your profit levels to be actually lower within the next few days, right? And you still clip a small profit to refresh your overall funds into your other targets. Now, bear in mind, right, $50 is a small profit, but when you add on to the original capital of the card, say $500, so it's a significant amount of money coming in. It's not just $50 profit coming in. So you have to note that you are actually reloading, right? And some people find this hard to grasp, especially when they just look at the profit margin itself, that's significantly lower, and the expectation of that profits, that they actually earn, it's much lower than when they first started. But of course, simple economics says that small profit margin is better than no profit margin, and of course, given it's within a reasonable time frame, of course. And in card investing, both variables are totally within your control. Okay, this may come as a surprise to some of you, but in almost 2/3 of my purchases of cards, whenever I make a purchase, right, I write down the value of the cards immediately by 20%, right? Doesn't matter it's raw or graded. You're probably thinking, that's so silly, right? Why do you do that? All right, okay. Again, it's the expectation when you play this game, when you have to take the approach that not everything you buy can sell at a profit or break even immediately. There is a cost to sell. When you acquire a card, there is time, you have to wait for the buyers and things like that, right? Even if you don't use platforms like eBay or MySlabs and solely sell cards on shows or local card shows, right? So there is time cost, there is your gas, there is travel. All these are technically need to be quantified. A lot of us don't really come to terms or accept that, right? You probably think that marking down numbers is just an illusion, but anyone can mark down numbers, right? It's just all in your Excel, and that's true. But I like to always take a very realistic and conservative approach in my portfolio, and occasionally I take drastic steps in writing off certain inventory completely, right? Especially when those cards are really deep underwater, which happens more often than you think, even for a seasoned card investor like myself here. But this writing off or this write downs, and this action itself is not to discourage or to demotivate, but in fact it's the opposite, where it forces you to consistently evaluate and reevaluate your portfolio and your positions, making certain moves that are necessary, whether is it to free up cash, to clear your dead inventory, or maybe just to adjust some of the prices on some of the other cards, right, in order to compensate the write-downs or write-offs. These are constant activities which you need to keep your mind actively thinking about your cards and consistently shape or change your expectations in the foreseeable future, be it next 1 week or 1 month. All right, so that concludes just an initial episode here, and I hope you guys got something out of this. And whether or not you enjoyed or did not enjoy this type of content, I want to hear in the comments below, so see what I can do to improve the channel or to improve this sort of content. Do subscribe, follow this channel, and once again, thanks for watching, guys. Come on out.